Evening, students. Good evening, Shankara. Welcome to the session. So, have you revised the last class? Yes, students. In the last class, what we started was the section 9 of the Income Tax Act, right? In section 9, we had seen that section 911, it says that all the income accruing or arising directly or indirectly through or from the business connection in India, through or from the business connection in India, right? And there we had seen that what is the meaning of the business connection? It is not defined. So there has to be some real and intimate connection with the activities carried out in India and the income that is getting generated therefrom, right? And then we had seen that business connection explanation 2 says it includes a dependent agent, one who has and habitually exercises the authority to conclude contracts or habitually concludes the contract or habitually plays the principal role leading to the conclusion of the contracts that had come through the BEPS Action Plan 7 and the multilateral instruments, right? Then we had seen and habitually secures the orders for mainly or only for the non-resident or its related entities, and habitually maintains a stock of goods and regularly delivers net profit. Under the treaty, we have a definition of permanent establishment. In order to tax the business profits in the source country, there has to be the permanent establishment. Permanent establishment is defined in Article 5 of the tax treaties usually, which includes the office, warehouse, outlets, delivery, showrooms, branch, place of management, construction, installation sites, the provision of services through the employees, dependent agent, and even an independent agent is excluded under the Act as well as under the treaty. But an agent who is working mainly or wholly for the non-resident, even though he's an independent character, but still he would not be considered as an independent agent. Okay. Yes. Good evening, Viraj. Good evening, Mansha. Good evening, Manish. Good evening, Namrata. So basically, if you see, then the Act says that not the entire profits, but the profits which are attributable to the activities or operations carried out in India will only be deemed to accrue or arise in India. That would include the income from the sale of advertisement, targeting the customers residing in India or who are accessing the Indian IP, sale of the goods or services using those, the sale of goods or services using the data collected from the person who is residing in India, and sale of data collected from a person who resides in India, right? Then we had seen the SCP will also be included in the business connection. SCP will also constitute the business connection. SCP is with regard to transaction in respect of goods or services, including download of data or software, which is more than, where the transactions are more than rupees 2 CR, or the interaction with the users, which is more than more than 3 lakh users, right? In that case, even the SCP will constitute the business connection. And then we had seen that what is excluded from the business connection: purchase for the purpose of export, collection and transmission of data for the viewing of the news, and then the cinematographic films production and the diamond in uncut in India. So those are excluded from the activity of display of rough diamond in SEC. These are excluded. And then finally, we can see what else is included in 911. The income arising from the property, from the asset or source in India, and from the capital asset situated in India. Fine. Yes or no? Any questions so far? Okay. So now what we are going to do is, since we are going to talk about the business connection, right? First, instead of going to the capital asset, first we will restrict ourselves to the business connection itself, students, right? We are going to see how the computation of the income of the non-resident works in terms of the business connection itself. And then we'll go to the rest of the parts of section 9, because now that we have seen when can the income be set to deem to accrue or arise in India? Deem to accrue or arise means there has to be some source of income in India, right? This is creating the source of income for a non-resident in India. This is only for the non-resident, because as I said, for the resident, entire income is taxable in India. Global income is taxable in India, right? Wherever arising. So this is only for non-resident. For non-resident, only the income accruing or arising or deemed to accrue or arise in India can be taxed in India. So therefore, when can the income accrue or arise? That we had seen. What is accrue or arise? That there has to be some source. And even when the income does not accrue or arise directly, but if there is the business connection here constituting, it will be set to deem to accrue or arise in India, right? Now, students, there is another section 9A, which is first we are going to study. It's little theoretical section at the moment for you, not always. So, section 9A. What is section 9A? Presence of, this is exclusion from the business connection. Presence of eligible fund manager in India shall not constitute business connection for the eligible fund. Shall not constitute the business connection of the eligible investment fund. Now, what is this, students? You would ask me. So, fund manager means what, student? Fund managers are basically managing the funds of the investment funds which are established. So just like mutual funds, there are a lot of FPIs, FIIs, AIFs which collect the investments and invest in the stock market, right? So what are these eligible investment funds? So eligible investment funds are basically the funds which are established or incorporated outside India, which collects the funds from its members for investing in for their benefit. So basically these are the investment funds. So funds incorporated outside India, collecting and investing funds, which are collecting and investing funds for their members. And there are different conditions for that fund. So there are different conditions that the participation of the residents in that fund should not be more than 5%. The fund should have minimum of 25 members. There are different conditions given under the Act. But primarily, this is the investment fund which is existing. If they satisfy certain conditions which are given under the Act, there are many conditions given. The investment should not exceed 20% of the corpus of the fund, or the member of the fund should have not any particular member should not have more than 10 participation. The corpus of the fund should not be less than 100. So there are many conditions. But primarily, you have to understand that the investment fund is somebody that is something that invests for their members, collect and invest just like mutual fund. And the eligible fund manager is what? Who is engaged in the activity of fund management, who is managing that fund in India. It happens in mutual fund also, right? So basically, again, for them also, there are certain conditions. They are acting in the ordinary course of business. They should be registered as the investment advisor with the SEBI and be connected to the investment fund, all of that. So what particularly this section 9A says, that just because there is a fund manager who is managing the fund of the foreign fund management investment fund, that will not constitute the business connection. That will not constitute the business connection for the investment fund, subject to the fulfillment of certain conditions. Subject to the fulfillment of certain conditions. So basically what they say is that if these conditions are fulfilled, then it's an eligible investment fund, there is eligible fund manager. If these conditions are satisfied, then that fund manager will not constitute the business connection. That's very simple. That's a limited point I wanted to make over here. Are we clear? I will zoom in a little bit. Is it fine? Dilip and Prerna, is it okay now? Yes, Shankara, NR taxation is really interesting. In the real life also, this is just, I give an example to the students that this is not even the tip of the iceberg. So this is something which is just a starting point, just to give you an idea as to how the entire block of ice may look like. So this is something which is very, very, very interesting as a career option as well. And for something as in the law stream, if you want to get into litigation, this is something which is very, very interesting. And it's like every day we get to see so many new things under international tax. Okay, nevertheless, students, so basically, this is the exclusion from the business connection, which is section 9A. So it says that the eligible fund manager will not constitute the business connection for the eligible fund. Yes or no? Is it clear, students? Any questions, any doubts so far? Yes or no? Yes, students, is this clear? Okay. Any doubt? Any questions? Okay, fine. Now, what we are going to do is the computation of the business income, how it happens in the case of a non-resident. So, we had not done that at the time of the PGBP because this is part of this particular chapter. So, we are going to do it at this particular point of time. So, there is presumptive taxation for the non-resident, just like you had it 44AD, 44ADA for the residents. For the non-residents also, there is presumptive taxation. So what is this presumptive taxation? So there are different sections. First is in respect of the shipping business. So for shipping business, there are two important sections which talk about the shipping company's taxation. So what are those? We are going to see for that. First is section 44B. First is section 44B. 44B is basically a section which provides for presumptive tax rate. And the second one is section 172. So 44B and 172. Two sections. So what does section 44B says? 44B says that the profit and gains of a non-resident engaged in the business of operation of ships. So basically this is applicable for the shipping business, right? Would be 7.5% of, so presumptive rate of 7.5%. 7.5% of a amount paid or payable, whether in or out of India, to the assessee or to any person on his behalf on account of carriage of passengers, livestock, or goods shipped at any port in India. Second, plus amount received or deemed to be received in India by the assessee by or on behalf of assessee on account of carriage of passengers, livestock, or goods shipped at any port outside India. Are we clear? On account of carriage of passengers, livestock, goods shipped at any port outside India. And this amounts would also include amount would include demurrage and handling charges. Demurrage and handling charges. Are we clear? So section 44B is the presumptive tax rate. Secondly, you will not get no deduction of the expenses. Just like under 44AD, there is no deduction of the expenditure. Here also under 44B, you will not get any particular deduction. Are we clear? So let's say, for example, there is a shipping company, which is a non-resident foreign company, which is engaged in the business of carriage of goods shipped at Mumbai port. Let's say, for example, this has A Limited, let's say, a non-resident company, or you can write a foreign company engaged in carriage of goods to ship. It is engaged in the carriage of goods through the ship. Now, let's say, for example, I'll give you the amounts. It is operating a shore and India. It operates the ship between India and Singapore. Are we clear? Then, in that particular case, it is engaged in the carriage of goods shipped at Mumbai port, and it received the following amounts. So let's say, for example, it has received certain amounts on the carriage of goods and on for the carriage of passengers. 1 second, there is some issue. 1 second, students, just give me a moment. Let me just copy paste the sum for you so that it becomes easier for us to solve. Yes. So it operates the ship between India and Singapore, and basically it has received the following amounts. Or you can first write down, it has operated the ship. It is engaged in the carriage of goods shipped at Mumbai port. It has received the following amounts. 2 crores in India on account of carriage of passengers from India. 1 crore on account of carriage of goods from Mumbai. 3 crores in India on account of carriage of passengers from Singapore. 1 crore in Singapore account on account of the carriage of passengers from Mumbai, right? So in this particular case, and the expenditure was 6.75 CR. So the question which arises, student, that on what you will levy these 7.5% students? That is the question. So the Act says that the amount paid or payable to the assessee, whether within India or whether the outside India. So if you look at the language in the Act, what it says is amount paid or payable to the assessee, whether in India or whether outside India. In respect of carriage of passengers, livestock, goods shipped at any port in India. So this is shipped at any port in India, passengers from Mumbai, 2 crores, which is paid in India. So this will any which ways be included, right? 1 crore is again paid in India on account of carriage of goods from Mumbai. So even this is included. 1 crore in Singapore on account of carriage of passengers from Mumbai. So whether even if paid outside India, so even this will get included. Then amount received or deemed to be received in India on account of carriage of passengers, livestock, goods shipped at any port outside India, students. So received in India, and this is on account of passengers from Singapore. So on all of this, you will calculate the 7.5%. You will ignore the expenses. So this is going to be, students, 2 CR, 1 CR, 3 CR, and another 1 CR. And 7.5% of that is giving us 52.5 lakh. So my PGBP shall be, students, 52.5 lakh. Are we clear, students? Yes or no? Namrata, eligible investment fund means the investment fund which is collecting the money and investing in different asset classes. These are the non-resident shipping company. Therefore, Dilip, it will be foreign ships. Demurrage charges, very good question, Namrata. Demurrage charges are basically the charges which are levied by the shipping company. So these are the charges which are, if let's say, for example, there are certain rules of these shipping company, right? So if these basically companies are violating any kind of rules which are written in the charter agreement, then the demurrage charges are payable by the owner of the ship on failure to load or discharge from the ship the goods which are lying. So sometimes it happens that they are not clearing the goods. They may call for the goods, but then the goods would still be lying in the ship itself. They may not come for clearing of goods. So handling charges or demurrage charges will also be included. 7.5% on gross basis. Yes, the way you calculate 8% on turnover, here also you will have 7.5% on the amount received or amount payable, which is there to the assessee, basically. Yes, believe 7.5% will be entire income. Amount paid or payable outside India, meaning, Namrata, the amount which is paid to the assessee outside India for the carriage of goods within India. Okay. Any other question? Fine. Then next is, students, you should have a question by now. You should have a question by now, ma'am. Then what was the tonnage tax scheme? Why this tonnage tax scheme is not applicable? Why we are not talking about tonnage tax scheme? In the assessment of various entities class, ma'am, you had spoken about the tonnage tax scheme. Student, why that is not being considered over here? Yes, students. Let me see who answers. Yes. To whom was tonnage tax scheme applicable? To the shipping companies. Then why are we not considering over here? Yes, students. Namrata, it is very simple. See, payable. It is paid or payable to the assessee only. So it is same as received. Don't get confused by that. It is amount paid or payable to my Indian external bank account on account of carriage of passengers. On account of carriage of passengers, livestock or goods shipped at any port in India. When the shipment of that consignment or the passengers is in India to any port in India, whether the amount is paid in India or outside India. Similarly, the amount which is received by the non-resident company in India for the port outside India, for the shipment to the port outside India. So basically, it says when the shipment of the port is in India, income is accruing or arising in India. So that will be included, where even if the amount is paid outside, but it is relating to the shipment which is coming to India. Secondly, amount which is received in India for the shipment outside India. So it's the same thing. Accrual and receipt. Both are taxable for non-resident. Either accruing or arising or deemed to accrue or arise in India. Point A is about that. Point B is about income received in India, even though it is sourced outside India. Are you clear, Namrata? Yes, Namrata, very good. That tonnage tax scheme is only for the resident and the, yes, it is only for the resident. Delete tonnage tax is not applicable for the movement of passengers. It is only applicable for the movement of goods. That's not the precise answer. So tonnage tax scheme which is there, it is not like that it is only applicable for the goods, isn't it? Yes, these are applicable where there is net tonnage of 15 net tonnage or more. It's a sea-going ship vessel. There are conditions, fishing vessel, there the qualifying ships which are there, harbors and river ferries which are there. But the correct answer is that the tonnage tax scheme is only applicable to the resident company, to the Indian company and the foreign company which has a place of effective management in India. So here you can write tonnage tax scheme not applicable to the non-resident company unless they are residents due to poem. Okay, so this is applicable only to a resident company. Okay, then we are going to talk about section 172. Now, students, if you remember our first class, very first class, the basic concept class, where we had spoken about section 4. Income of the previous year is charged or assessed to tax in the next following assessment year. So there we had discussed certain exception. One of the exception was shipping business of the non-resident. So income tax is charged before the ship leaves the port. One of the exception was section 172, and this is the time where we are going to discuss about 172. So basically, students, now we are going to discuss about 172. At that time, this was considered as an exception to section 4. So section 172, students, is a complete code in itself. It's a complete code for the taxation of occasional shipping business. Where you're not regularly coming to India, there may be an incident that this shipping company is just coming one-off for the first time in India. And the AO may think that this company may just go away and will not be present at the time of filing the return of income. So section 172 provides for the complete code. It has all the obligations, filing of return of income, assessment, passing of the assessment order, everything is contained in 172. It is a non-withstanding clause. It overrides all the other provisions of the Act. It's a non-obstant provision. It's a complete code. It's like the entire scheme is contained in 172, from the tax rate to the computation to the assessment. Everything is contained under 172. So this is a complete code. So this is a complete code of taxation for the shipping business. For non-resident shipping company, including the assessment and collection. Fine. Now, how the income is taxed in 172. So it says where a ship carries the passengers, livestock, mail or goods, then here also 7.5%. 7.5% of the rate is similar of amount paid or payable amount paid or payable on account of carriage of amount paid or payable to the assessee, amount paid or payable to the assessee on account of carriage of livestock, passengers or goods. I'm writing like LPG. Okay. whether that amount is paid in or out of India. Whether paid in or out of India. Here, they are not talking about the amount received in India on account of the shipment to a port outside India. Here, what they are talking is amount received or receivable on account of the carriage of the ship, on account of the carriage of the passenger, livestock, or goods. Whether that amount is paid in India or outside India. They are not even talking about where the port is, where the shipment is in India or whether the shipment is relating to the port outside India. They are just saying this shall be deemed to accrue or arise in India. Are we clear? So 7.5% of the amount payable to the paid or payable to the SSC, whether in India or whether it is going to be paid outside India, students. So this is how it is different in terms of the, this is how it is different in terms of the 44B. It just says 7.5% of the amount paid or payable on account of carriage, whether payable in India or payable outside India. The tax here is going to be on the 7.5%. The tax is going to be at the rate of 40%. Tax shall be at the rate of 40%. On this amount, tax at the rate of 40%. Are we clear? Whether that ship owner is an individual or whether he is going to be a company. Right? So therefore, here there is going to be a tax rate of 40%. Now, this particular owner of the ship has an obligation to prepare and furnish a return of income of the amount which is paid or payable to him on account of the carriage of any passengers, livestock, or ships or the goods shipped at any port in India. So they have an obligation to furnish the return of income. They have an obligation to furnish the return of income. So return of income to be filed. So as I said, 172 imposes all the obligation, the return of income, tax collection, everything is contained in 172 itself. Okay, yes, this is in relation to the shipped at any port in India. You can write here. Amount paid or payable to the assessee on account of carriage of LPG, livestock, passenger or goods. Whether paid shipped at any port in India. Yes, it's not relating to the any port outside India. Under 44B, amount received in India, which is in relation to the shipment to any port outside India is also included. Here it is not included. Here it is only ship carrying the passenger, livestock or mail or goods shipped at any port in India. 7.5% of the amount paid or payable on account of such carriage, whether that amount is paid or payable in or out of India. Okay? In or out of India. Shall be deemed to accrue or arise in India. So before the departure, the return of income has to be filed. So as I said, this is the exception to section 4. This 172 is exception to section 4 as income of the previous year assessed to tax in the previous year itself. So ROI to be filed before the departure of the ship. So ROI needs to be filed before the departure of the ship. And the tax also needs to be paid. And the tax also needs to be paid. Plus taxes to be paid. So before the departure of any port, from any port in India, the master of the ship will have to furnish the return of income of the amount which is received uh, to him on account of the carriage of passenger, livestock or goods shipped at any port in India, and he has to make the arrangements for the payment of the taxes. Are we clear? Then on receipt of the return, the AO will assess the income and determine the sum payable, whether the sum payable is correct or not. Are we clear? And then the order of the assessment will be passed. The order of the assessment will be passed. So after this, AO shall assess the tax payable and finally will give the port clearance certificate. So until the port clearance certificate is received, the ship cannot leave Indian port. Are we clear? Yes or no? Here also, one more thing, under the 7.5% of the amount, the demurrage charges and handling charges will be included. In the 7.5%. Now, if the assessee wants, they can claim this as an advance tax if they want to go for 44B in the assessment year. So this can be set off against, so tax paid can be considered as advance tax if assessee opts for section 44B in the assessment year. So it is possible that the assessee in the assessment year may opt for 44B and then he can claim the tax paid under 172 as the advance tax. Is this clear? Thank you, Ramesh. Thank you so much. Namrata, there is difference of only one particular point. In section 172, the point B which is there, this is not present. Only the point A is present of 44B. B point is not present. So amount received or deemed to be received in India on account of the carriage of the LPG shipped at any port outside India is not there in section 172. Only amount point A is there, which is in respect of the shipment at any port in India. Mansha, there is no choice available to non-resident either 172 or 44B. The thing is that when before the ship leaves, they have to be assessed under 170. It's a non-obstant clause. It overrides all the other provisions of the Act. In the assessment year, they can opt for 44B and claim the advance taxes paid under 172 and can go as per 44B also. Tax rate under 44B is also same, 40% for a foreign company. For a non-resident, it will be the same as per the individual tax rate. Is there any conflict between 44B and 172? No, there is no conflict. You have to read it harmoniously. So 172 is only saying that before the ship leaves, you pay your assessment. You get your assessment done as per 172 so that tomorrow it should not happen that you do not come back to India and we have not even collected the taxes. Clear? Yes or no, all of the students? Yes. Namrata, it's a simple thing. As I said, that 44B is saying that the presumptive rate of 7.5% will be applicable on the amount which is received, whether in the Indian bank account or in the foreign bank account, in respect of carriage of livestock, passenger goods, LPG, shipped at any port in India, plus the amount received or receivable with respect to amount received or receivable in India in respect of the carriage of LPG to any port outside India. Under 172, you only have 7.5% of amount paid or payable, whether in India, outside India, in respect of shipment of LPG at any port in India. It is not covering any port outside India. The shipment to any port outside India is not covering. So under 44B, there is accrual. This is the accrual and this is the receipt. So this is the accrual in India because the shipment is coming to India. This is receipt in India of the source outside India. Right? So it's the same concept as section 5. For a non-resident, income accruing, arising, deemed to accrue or arising, income received or deemed to be received in India are taxable. It's the same concept. Under 172, we only have the income accruing in India which is covered. Demurrage handling charges, you will include it. No reduction of expense under 44B. Under 172, it is also 7.5%. Under 172, it is also 7.5%. But under 172, before you leave the Indian port, you have to file return of income, pay the taxes, and then get the assessment order and the port clearance certificate. Are we clear? Yes or no? Okay, students. Any questions? Any doubt? Okay. Shall we proceed further? Yes or no? Okay, fine. So let's proceed further then. Next particular point is the presumptive taxation for the aircrafts. Presumptive taxation for the business of operation of aircrafts. So this is under section 44B, which is operation of business of the aircraft. Okay, business of operation of the aircraft. So business of the operation of aircraft 44BA provides the presumptive rate in case of the non-resident engaged in the business of operation of aircraft. What is the presumptive rate? Your presumptive rate is 5%. 5% of, again, the same thing, A, amount paid or payable whether in or out of India, whether in or out of India, to the taxpayer on account of carriage of livestock, passenger or goods, carriage of livestock, passenger or goods from any place in India. Plus the B point, amount received or deemed to be received in India by the taxpayer on account of carriage of livestock, passenger or goods from any place outside India. So same as the 44B. First is the accrual in India, because there is the livestock, passenger or goods going from the airport in India. So amount whether received in India or outside India in relation to the aircraft which is operating from India. And secondly, the amount which is received in Indian bank account with respect to the aircraft being operated outside India. So both will get included. So second is the received concept. So say for example, Lufthansa airline is there, operating the flight between India and Frankfurt, Germany. Lufthansa Airlines, right? Now it is receiving the, let's say, the ticket amount for the passenger tickets. It is receiving the amount, let's say in Germany, for the flight being operated from Mumbai to Frankfurt. That amount will be taxable in India. 5% of that amount will be presumptive income. A. B is, let's say, for example, the Lufthansa airline is operating the flight from, let's say, Frankfurt to, let's say, Rome, and the amount is received in the Indian bank account. So 5% of that will also be taxable. Are we clear? Yes or no? Yes, students, is this clear? So 5% will be taxable. Third presumptive income is business of exploration of mineral oils, section 44BB. Business of exploration of mineral oils. Again here, there is eligible assessee is a non-resident engaged in the business of providing the services and facilities in connection with the prospecting for or extraction of production of mineral oils, or supplying the plant and machinery on hire to be used for prospecting or extraction of production of mineral oils. So, non-resident engaged in providing services or facilities in connection with or supplying plant and machinery on hire to be used for prospecting or extraction of or production of mineral oils. What is the presumptive rate over here? 10%. So here the presumptive rate is 10% of, again the same thing, amount paid or payable to the assessee, amount paid or payable to the assessee, whether in India or outside India, on account of the services provided in India. Plus B is received, amount received or deemed to be received in India, amount received or deemed to be received in India by the assessee for the services provided outside India. Again, this is the presumptive rate which is given. Yes or no? Any questions, any doubt? Here, the assessee has an option to claim the profits lower than 10% if he maintains the books of accounts and get the books of accounts audited. So, option to claim lower than 10% if books of accounts are maintained plus audited. Under 44B, under 44 double B, 44 BBA, 44B, which is the shipping companies, and for the aircraft, which is BBA. In both of these provisions, there is no option to claim the lower profit. There is no option to claim the lower profit. There it is mandatorily you will have to either go or you will not opt out of it. There is no option to claim lower than that. But under 44BP, there is an option to claim the lower profits than 10%. And in that particular case, you have to get the books of accounts audited and the books of accounts need to be maintained as well. However, there is an amendment which has been recently made. So it says that where the assessee declares the profit and gains in accordance with the presumptive taxation. So where the assessee declares the 10% profit, in that case, the unabsorbed depreciation and business loss also would not be allowed. So this is the recent amendment. So you can write it over here. No UAD and brought forward business loss is allowed against the presumptive rate. Fine. Then the next one and the last one in terms of the presumptive taxation is 44 triple B. Which is in respect of foreign companies engaged in the civil construction. Engaged in the civil construction for the turnkey power projects. In this case, the presumptive rate is again 10% of the amount paid or payable, whether in or out of India, to the assessee, on account of civil construction, erection, testing, or commission. Okay. So that will be provided. Again, here, no set off of UAD and brought forward business loss. Here also there is an option to claim lower than 10% by maintaining the books of accounts and getting the books of accounts audited. If books of accounts maintained and audited, students. So this is your presumptive taxation for the non-resident. Yes. Any doubt, any questions? Yes, so prospecting means finding out where the mineral oil and then finding out basically drilling and digging out where are the areas where the mineral oil could be located, Namrata. Yes or no, students? Any questions, any doubt? Is this clear? These are very simple things, nothing much to be thought about. I didn't get exactly what you are saying, Dilip, clerical error as in 44 double BA. What is the problem in 44 double BA? Okay, here you are saying yes. Is this correct? Operation of aircraft is 44 double BA. Okay, understood. Fine, students. Now the next section which is there. This is very, very important, which is the deduction of the head office expenditure in case of the non-residents. This is very important. Now, what is this section? Let's talk about that. This is a separate section itself, not under presumptive. Deduction of head office expenses. Section 44C. Now, what is this, students? Understand. As I said, in case of a non-resident students, see, when we were dealing with the income deemed to accrue or arise in India, this particular point, what did I tell you, students? I told you that if you look at this particular point, I said that the entire sales of 1 lakh will not, right? So what is going to be taxable, students, here is the profits which are attributable to the operations or activities carried out in India, right, by this branch. Now, if you see, one thing I said is that the transfer pricing will be applicable to compute what are the arm's length profits which should be attributable to the branch. There could be the percentages of the turnover. Presumptive taxation is another option. In case of specified non-resident, right? This is another option because this is the profit which will be attributable to the operations carried out in India for these companies, what we saw. Third thing is, I will make this P&L for the branch. I will make this P&L for the branch to find out what are the profits attributable to the Indian operations. Because what did I tell you is what activities the branch is carrying out. Only to that extent the income will be taxable. That is what the profits attributable to the operations mean. Right? The activities which are carried out outside India, that cannot be taxed in India. The profits to that extent cannot be taxed in India, right, students? Only to the activities which are carried out by branch, which is resulting in the business connection, which is what? The connection between the activities carried out in India and the income which is generating therefrom. Only that portion of the income can get taxed here, right? Correct? So I will make a branch P&L separately. You do in even the accounts also, right? Branch P&L. So while making the branch P&L, there is a possibility, students, that a branch may pay the head office expenses. So a branch may pay certain expenses to the head office. Now the deductibility of that is covered under 44C. The deductibility of that is, students, covered under section 44C. Yes? So now what 44C is telling us? Let's try and understand. It says the head office expenditure will be restricted to this much amount. restricted to A, 5% of adjusted total income. 5% of the adjusted total income. Or in case of loss, 5% of average adjusted total income. And B is the expenditure in the nature of head office expenditure incurred by the assessee in India. Incurred in India. Lower of this amount shall be taxable. Yes. Okay. So lower of these two amounts shall be taxable. Now, what is my adjusted total income, students? What is my adjusted total income? So adjusted total income means total income without considering the HO expense. Secondly, unabsorbed depreciation, capital expenditure on family planning, capital expenditure on the family planning, which is again remaining unabsorbed. So basically, you can write down the unabsorbed capital expenditure on the family planning. Remember under section 36(1)(9), we get the deduction for the family planning expenditure, right? Which shall be allowed to you over the period of 5 years. So the unabsorbed amount which is remaining, so that amount which is 1/5 which is allowed as the capital expenditure, that will be not allowed. So 1/5 which is allowed, right? So that shall not be considered without considering that. Then business loss, speculation loss. So losses which is business loss, or you can write business loss. Then capital gain loss, speculation loss, and capital gain loss, losses from maintaining and owning the race horses. And deductions under chapter 6A. So total income without considering these is your adjusted total income. So 5% of the adjusted total income. In the case of loss, 5% of the average adjusted total income. Average meaning for the 3 assessment years immediately preceding the relevant assessment year. Okay, so for the average of the 3 assessment years, we will have to consider. Okay, so average adjusted is for the 3 assessment years preceding the relevant assessment year. Okay. Then what is my head office expenditure over here? So head office expenditure will be executive and general admin expenditure. And general admin expenditure incurred by the assessee outside India in respect of rent, rates, taxes, repairs, or insurance of any premises salaries paid outside India, then travel expenses of the employees outside India, okay students, fine. So this is how 44C will be calculated. Yes or no students? Any questions, any doubt? Fine. Let's solve one question on that. Let me give you a question from your module itself. Net result of the business carried on by branch for the year ended was a loss of 100 lakhs after the charge of HO expenditure of 200 lakhs. Explain with the reasons the income to be declared by the branch in its return of income. Yes. What will you do in this case, students? Yes, students, faster. Yes, Dilip, very good. Correct. You are right, Dilip. Okay. So students understand over here. What we'll do is we will first add back the HO expenditure to calculate the adjusted total income. So my adjusted total income is going to be 100 plus 200 lakhs, right? So there was a loss of 100 lakhs. So plus 200 lakh, this will give me 100 lakh as the adjusted total income. So 5% of the adjusted total income, which is 5% of 100 lakh, which is 5 lakh. Right, isn't it? And then the lower of the 5% of the adjusted total income, students, and the actual expenditure which is incurred as the head office expense. Lower of these two. So 5 lakh allowed as deduction under section 44C. Clear, students? So with this, your PGBP gets completed for the non-resident. So students, you will ask me, ma'am, what about the other non-residents which are not covered under presumptive? What about other than the shipping, aircraft, mineral oil, civil construction, other than those companies, like a general non-resident who is doing the sale purchase, who is providing the services here in India? They will compute as per the normal provision. Section 28 onwards to 44. They will go as per the normal provision. So they will compute as per the normal PGBP chapter. So the computation of income will be as per the PGBP chapter what we have learned so far already. Are we clear? So that shall remain the same. Can 44AD be applied by a non-resident company? The company, or the, let's say not company, let's say non-resident individual or a partnership firm, any which ways company is never covered under 44AD. So 44AD, can it be applied by a non-resident individual? Answer is no. Yes, Shankara, yes, Mansha, you are right. So 44AD can only be applied by the residents, and same is 44ADA. So they cannot go onto that particular section. But whatever the rest of the provision, they can claim deductions as per 36, as per 37 general allowance. The disallowances will remain the same as under 40A, 40B. All of those disallowances will remain the same. So everything else will remain the same for them, students. They can have their income chargeability under 28 onwards. So everything what you have learned under PGBP will apply for the non-residents equivalently. But these are certain special provision for certain categories of the non-resident, which is what we understood. Clear, students? Any questions? Any doubt? Anything you wish to ask before we move on to the next particular topic? If no, we can take a small break. Okay, so let's take a break of 10 minutes. Okay. So basically, students, are we clear about this? Yes, Mansha, every other company can claim 44C. Not except shipping aircraft, every company. It's including all the companies, even shipping aircraft, everybody can claim. Okay, Mansha? Fine. 44C is for everyone. Okay, let's proceed further then. So students, 911, we started with that. Okay, I'm again going back to, we are not yet finished that 911 portion, right? Because something major is pending on our end. So I'm going back to 911. So if we see 911 says business connection, transfer of a capital asset situated in India, source of income in India, right? We have different things. We have done it already. We spoke about in the last class, through or from any property in India, through or from any asset or source of income in India. Last one is through the transfer of capital assets situated in India. Now here it also includes indirect transfer. We'll study about this now. So just write down indirect transfer. Indirect transfer of capital assets. Now I'll explain you the logic, students. What is the logic behind this? So students, what happened in 2000 and this is a story of 2012, students. When Vodafone deployed a strategy, not Vodafone, sorry, the Hutch company. At that, before Vodafone, it was Hutch. Okay. Now we have Vodafone, but at that point of time, it was Hutchinson SR Limited. Now this company deployed a strategy, students. What strategy do they deploy? So basically, what they tried to do was, let's say, for example, this is Hutch Hong Kong. Okay. This, instead of coming Hutchinson SR Limited, directly investing in this company, what they try to do is they incorporated the intermediate company, or we call them the SPV, Special Purpose Vehicle, in the tax havens country. What are tax havens, students? The zero or nil tax countries, tax havens. They incorporated the SPVs in between. Now, why did they incorporate the SPV in between? Because this kind of arrangement is known as, student, treaty shopping. You know, when you go for shopping, what you try to do, students, is you go and look around the stores, different stores, and then you say that, okay, I like this particular dress. Let me ask with this other shopkeeper also, or I like this shoe. Or nowadays, even if you look at the online shopping that we are doing, students, what we try to do is, first we try to check the price on Myntra, then on Flipkart, then on Amazon, then on, say, Nika Fashion, then on, let's say, eBay, or any kind of website. We'll try and compare and see where I'm getting the least discount. Isn't it? So you are doing the app shopping. Similarly, we have something called as treaty shopping. So these companies, whenever they are investing in, sorry, whenever they are investing in any jurisdiction, they try to look out for the favorable treaty countries with that source jurisdiction. They try to identify with which country India has the favorable treaty positions. Because as I said, all the treaties are different from each other. It depends on the bargaining power between the two countries, the economic power that the two countries have between one another. So every treaty is signed differently. Every treaty will have a different position. So they look out for the most favorable treaty with the ultimate source country where they want to invest. And they will make the SPVs, the special purpose vehicles, or the intermediate entities in between. These special purpose vehicles are what? These are just the holding entities. They have just a special purpose of holding in the ultimate country. These are just holding companies. So this Hutchinson did the treaty shopping and they incorporated the SPV in Cayman Islands, in Mauritius, through a web of companies. They came to India. Now the time came they wanted to exit from India. And Vodafone at that point in time was looking to enter in the Indian market. See, the telecom sector is a very restricted sector. Since always, it's not easier to obtain the telecom licenses, the spectrum licenses, right? It's a very, very stringent and regulated sector which is there. So Vodafone thought that if I come in and start my business over here, so it will be very difficult to establish the business from the outset. So let's do one thing. Hutch was planning to exit from the Indian market. Vodafone said, I'm ready to purchase your business. So you give me the business in India. I want to enter into the Indian market. So what Hutch did is, they transferred the shares of SPV instead of the shares of the HEL. Now, what was the reason behind that, students? The reason behind that was, students, that if they would have sold the shares of the HEL, what would have happened? Transfer of capital asset situated in India, right? The shares of the Indian company are situated in India. The company is registered in India, meaning the shares are situated in India. The situs of the shares is where the company is registered. So shares of Indian company are situated in India. So what would have happened? There would have been a transfer of capital assets situated in India. So section 911 says income deemed to accrue or arise in India. So what would have happened? Capital gain on sale of HEL shares would have been taxable in India. So what they did is, instead of doing like this, they said, let's not get into this. We do not want to pay tax on the exit. So HEL said, Hutchinson said, let's sell the shares of this SPV company. So the capital gain will not be taxable in India because this SPV shares are not situated in India. So the capital gain will accrue or arise outside India. The consideration for the sale will also be paid outside India. So the consideration paid outside India. So there is not even receipt of the consideration in India. So for a non-resident, the global income cannot be taxed. Only the income deemed to accrue or arise or accruing or arising in India can be taxed. Here the income was not accruing or arising. It was not even deemed to accrue or arise. It was not even received. So income of the Hutchinson Hong Kong on the sale of the shares of the SPV are not taxable in India. This way they sold the entire business of the Indian company because the SPV's business is only to hold in the shares of HEL. So by purchasing the shares of the SPV, Vodafone indirectly purchased the shares of the HEL. Because now here Vodafone will be holding the shares of SPV. If you look at the balance sheet of SPV, it had the share capital, which is held by Hutchinson. And then it had the investments in HEL shares. That's it. This is a balance sheet of SPV. The income tax department said, no, this is tax avoidance. Though it is as per the letter of the law, it is in violation of the spirit of the law. This is tax avoidance. The matter went to the Supreme Court. The Supreme Court said there is nothing in the law which creates the charge for this company. For a non-resident to be taxed in India, there has to be a charge getting created. If you look at section 5, income accruing or arising, if you look at section 911, it only says transfer of a capital asset situated in India. Is this shares of the SPV situated in India? The answer is no. So there is no charge which is getting created. So you cannot tax that income without the charge taking place. Isn't it? So therefore the Supreme Court gave the decision in the favor of Hutch that transfer will not be taxable in India. The Parliament said, let's amend the Act. And the Act was amended. So what was the amendment carried out? The amendment was, amendment to section 911. The explanations were introduced to section 911, students. And what was the explanation which was introduced? Explanation 5 was introduced, which said that share of the foreign company in our case, let's say this Cayman Island SPV shall be deemed to be situated in India. Shall be deemed to be situated in India, meaning the shares of this SPV will be deemed to be situated in India. Shall be deemed to be situated in India. If the shares derive the value, directly or indirectly, substantially from the assets located in India. If shares derive the value directly or indirectly, substantially from the assets located in India. Are we getting this particular point? So, the shares of the foreign company, if they derive the value substantially from the assets located in India, then in that particular case, the share of the SPV will be deemed to be situated in India. So this is what the amendment was carried out. So share of the foreign company shall be deemed to be situated in India if the shares derive the value directly or indirectly substantially from the assets located in India. Now you will ask me, ma'am, how will we know whether the shares derive the value from the assets located in India? So for that, the explanation 6 provides you the answer. So this is the explanation 5. Explanation 6 defines the word what is deriving the value substantially from the assets located in India. It says, if on the specified date if on the specified date. Now, what is specified date? I will explain it. If on the specified date, value of the Indian assets, you can write like this. Value of the Indian assets on the specified date. Value of the Indian assets on the specified date exceeds rupees 10 crores. Exceeds rupees 10 crores and is greater than equal to 50% of value of total assets of the company. So, value of the Indian assets is exceeding rupees 10 crores and is greater than equal to 50% of the total assets of the foreign company. So basically, if you look at this balance sheet, if this value of Indian assets is greater than rupees 10 crores plus is greater than 50% of total assets of the SPV. This. Then in that case, this particular SPV's shares, this will be deemed to be situated in India as they derive value substantially from Indian assets. So basically, if you look at the share of this SPV is deriving the value from this investment. So as this company will grow, the shares of this company will grow. Isn't it? So the value of the Indian asset is more than 50% of the total assets and value of the asset is greater than rupees 10 crore. Now, what do we mean by the value of the asset? The value means the fair market value. The value means the fair market value. This means the fair market value. The FMV of the Indian assets. Now, as on the specified date. So, what is the meaning of the specified date? So, for that, the specified date is defined as, you need to ask if the you need to ask if the book value of the assets on the date of transfer is greater than the 15% of the book value of assets on the last date of the accounting period. What do you need to ask? Book value of the assets, book value of the assets of the company, book value of the assets of foreign company is greater than 15%. Book value of the assets of the foreign company as on the date of transfer is greater than 15% of the book value of the assets of foreign company as on last day of accounting year. If the answer is yes, the answer is yes, then it shall be date of transfer. Then the specified date will be date of transfer. If the answer is no, then the date of accounting year. So last date of the accounting year. So basically for determining the specified date, you need to consider the book value of the assets of the foreign company. If that is book value as on the date of transfer is greater than 15% as on the last date of the accounting year, then you take the date of transfer as the specified date. Then you consider the fair market value on the date of transfer. Otherwise, you consider it on the last date of the accounting period. Finally, there is an exclusion given over here. What are the exclusion? Which companies are not covered under, or what is not covered under the indirect transfer? So the exemption is given where the transferor does not hold right of management or control. Where the transferor does not hold the right of management or control. B. The transferor holding less than equal to 5% of the total share capital or voting power. So less than 5% holding, meaning the small shareholders are excluded. The right of management or control is excluded. If you are not holding the right of management or control, then also you are excluded. So basically, this is to protect the small shareholders, because it should not happen that if, let's say, for example, a small shareholder transfers the shares of the SPV, it should not happen that the capital gain gets attracted in India. So where you're not holding the right of management or control, or you're not holding the, you're holding less than 5% of the total voting power, both of them are excluded. Yes, any question? Any doubt? Yes or no, students? Then who else is excluded from this particular indirect transfer? The FPI, foreign portfolio investors, which are again the small shareholders which are coming on to invest in the Indian stock market. So FPIs are basically the foreign portfolio investors where their holding is not more than 10% in the Indian stock market. They come through the, again, SPVs, and then they invest in the Indian stock market. But these are registered with SEBI as FPI. So asset held by the non-resident by way of investment in FPI, foreign portfolio investors. Are we clear? Yes or no? Any question? Any doubt? Yes or no, students? Then asset held by non-resident in the foreign venture capital investments or venture capital funds. Venture capital fund, you can write. Okay. So even that shall not be considered. Lastly, if let's say, for example, the dividend is declared by this SPV. Let's say this SPV declares the dividend. Now, when I'm saying that the shares of the SPV are deemed to be situated in India, there was an apprehension which was created that if the dividend is declared in respect of those shares, whether the dividend will also be deemed to accrue or arise in India. So the CBDT has clarified that dividend on the shares dividend on the shares which derive the value substantially from Indian assets shall not be deemed to accrue or arise in India. Yes, the dividend will not be deemed to accrue or arise in India. Clear? Namrata, you will understand. We'll solve a question on this. So you will understand basically what I'm trying to say. Let's take up the question now so that you understand what is indirect transfer and how does it work. So let me just put a question before you. And we will solve it together. Give me a minute. Give me a student's minute. Hope it gets copy pasted now. No, it's not getting pasted. Yeah, it's done. Actually, this app works very slow, so that's why I face a lot of problem. Yeah. I hope you are able to see the question. Okay. So ABC, a company incorporated in Mauritius, is a wholly owned subsidiary of ABC PLC, a UK company. ABC PLC UK enters into a share transfer agreement with PQR Inc., a Singapore company, as to transfer the share of its subsidiary ABC Limited in Mauritius. So basically, ABC PLC is entering into a share transfer agreement with a Singapore company to transfer the shares of its subsidiary ABC Limited in Mauritius. Agreement is entered in UK. PQR has discharged the sale consideration in USD from its UK bank account. ABC Mauritius has certain tangible, intangible assets located in India. Following information is provided. Date of transfer is given. Last date of the accounting period is given. Book value of the assets of the ABC Limited Mauritius as on 25th June 2022, which is the date of transfer, which is located in India, located outside India. Book value of the assets of ABC Limited Mauritius on 31st 12 2021, which is the last day of accounting period, is given, located in India and located outside India. ABC has liabilities pertaining to these assets which are situated in India and outside India. There is no amalgamation or demerger of ABC PLC and XYZ Inc. ABC PLC owns individually more than 5% of the shares of the ABC Limited Mauritius during the 12 months before the transfer. However, it does not hold the right of management or control at any time during the 12 months. Also, you will have to write here, assume the book value is equal to the fair market value. Okay. So first scenario. Now I'll explain you how we do the calculations here. So you will understand the fundamentally also that what is the provision all about. So students, the step one which is going to be there. The step one which is going to be here there is the calculation is the identification of the specified date. Is the identification of the specified date. So my step one is identifying the specified date. Okay. So just write down step one, identification of specified date. So for specified date identification, what did I tell you? Whether book value of the assets as on the date of transfer of the foreign company are greater than 15% of book value of assets of the foreign company as on the last date of accounting year. If the answer is yes, then date of transfer is your specified date. Otherwise, it is date of accounting year, last date of accounting year. Now, what is the book value of my asset, students, as on the date of transfer? The transfer has taken place on 26th, right? The transfer has taken place on 25th of June, right? 25th of June. So in the first situation, if you look at what is the book value of my assets as on the 25th of June, it is 114, right? It is 114, isn't it? Now, whether it is more than 15% of the book value of the assets as on the last day of the accounting period. What is on the last day of the accounting period? 100 CR. So, book value of the assets as on the last day of the accounting period is 100 CR, right? And as on the date of transfer is 114, right? So 115% of 100 CR would be 115 CR. Whether it is exceeding 115 CR, answer is no. It is 114 CR. So in the situation 114 CR is less than 115 CR, which is 115% of 100 CR. So then it will be 31st/12/2021. You come in situation 2. Go to situation 2. What is the book value of assets as on the last day of accounting period? Again 100 crores. This is 57 plus 59, 116 crores, student. So therefore, in the situation 2, 116 crore is more than 115% of 100 CR. So you will take 25 June What is the year? 22. In situation 3, students. Situation 3, it is again 114 plus 4, 118 CR. This comes to 115% comes to 136 CR. Sorry, not 118, it's 18 CR. Sorry, my bad. 18 CR. So 18 CR into 115% is 20 CR. And this is how much? 18 CR. Sorry, this is wrong. 11 crores plus 4 crores. This is 15 CR. So 15 CR into 115% is 17.25 CR. Right? So 18 CR is greater than 115% of 15 CR. So again, I will take here the date of transfer. Students, is this clear? Is this clear? Yes. Specified date, is it clear? I'll zoom in a little bit. Yes. So specified date, you check the book value of the assets of the foreign company. Whether it is greater than as on the date of transfer by 115% of the book value of the assets of the foreign company as on the last date of the accounting year. Namrata, it is very simple. What is the book value of the assets as on the last date of the accounting year? It is 100 crores. 115% of that, 115 crore. So, whether this value is greater than 15% of this value, this is your question. Whether the book value of the asset as on the date of the transfer. So you have to take all the assets located in India, located outside India. So this is 114 crore, Namrata. This is less than 15% of, this is less than 15% of 100 crores into 15% into 115%. In that case, you take the last date of accounting year. In this case, it is more than 115% of 100 crores. So there you take the date of transfer. Yes, is it clear? Deduction of head office expenses under the 44C. I said that capital expenses on family planning are not to be considered while calculating the adjusted total income. It's that only simple that point. The adjusted total income will be without considering the capital expenditure on the family planning. So you get 1/5 of the deduction for the capital expenditure, right? And the 3619, it says 1/5 of the capital expenditure will be allowed each year. So that portion you will not consider in the adjusted total income. That was the limited point, Amrita. Is this clear? How to take the specified date, students? Yes or no? The step 1 is very clear to all of you. Who has not understood as yet? This is very simple. Yes or no, students? I need the answers. Yes or no? Have you understood what is the specified date? Yes? Yes or no, students? Faster. I need the answer. Yes? Faster students, I need the answer. Specified date. Yes. I'm not getting answers. Yes, Namrata, okay. Yes, Santosh, clear. Okay. So step one is this. We got our date on which we have to consider the fair market value. Step two is value of the Indian asset is greater than value of the Indian asset. So you can first write down whether share of the foreign company derives value substantially from the Indian asset. Now to determine that, what we need to see whether value of the Indian asset is greater than rupees 10 crores. And this is condition 1. Second, whether value of Indian asset is greater than 50% of total assets of the foreign company. So here my value will be not the book value, but the fair market value. I need to consider here the fair market value. Okay, students. So I need to consider here fair market value. In situation 1, if you look at the fair market value, I've said book value is equal to the fair market value in this question. In situation 1, whether the fair market value of the Indian assets, now you look at only on the date of, in the first situation, or is on the last date of the accounting year. So we look at only this date in situation 1. Because the specified date is the last date of the accounting year. So whether the value of the Indian asset is more than 10 crores, answer is yes, it is 60 crores. So in situation 1, this is yes. Okay. Then whether the value of the Indian assets is more than 50% of the value of the total assets of the foreign company. So total assets are 100 crores. 50% of that is 50. Value of the Indian asset is 60 crores. So yes, this is more than the value of the total assets of the foreign company. So in this case, yes, the satisfaction of both the condition is there. So income will deem to accrue or arise in India. So the share of the foreign company will be deemed to be situated in India. And therefore, if it is deemed to be situated in India, the transfer of the shares of a capital asset situated in India is deemed to accrue or arise in India. So here, indirect transfer is satisfied. In situation 2, now you will look at the 25th June because in situation 2, specified date is date of transfer. So whether the value of the Indian asset is more than 10 crores, yes, it is 57 crores. So yes, it is satisfied. Whether the value of the Indian asset is more than 50% of total assets of the foreign company. So 116 into 50%, 58 crores. Is it more than 50%? Answer is no. So here in situation 2, this condition is not satisfied. And as I said, this is and condition, meaning satisfaction of both the condition is important. So if any one of the condition is not satisfied, students, indirect transfer will not be there in the second situation. So not there. In situation 3, again you look at only on the specified date, which is the date of transfer. So it is exceeding 10 crores. What we had written over here, value of the Indian assets should be more than rupees 10 crores. Should exceed 10 crore. In this case, it is equal to 10 crores. I have not written greater than equal to 10 crores. I have just written greater than 10 crores. Are we clear, students? So therefore, this condition will not be satisfied. So second condition we will not even look at, even if it is satisfied. Are we clear? So this will not be attracting the indirect transfer. Is it clear, students? Yes or no? Indirect transfer provision clear to all of you? Step 1, identification of specified date. For that you consider the book value of the assets of the foreign company. Once you identify the specified date, identify whether the value of the Indian asset is more than 50% of the total assets of the foreign company and value of the Indian asset is more than 10 crores. Yes or no, students? Any question, any doubt? Yes? Is this clear? Any questions, any doubt? Okay. Now, one more important point over here. One more question I will like to give to you. Okay, let me just put it before you. Now, this will be a more comprehensive question, which will clear your entire indirect transfer. Okay. ABC Limited is an Indian company, is owned by ABC Inc. Mauritius, which is in turn owned by ABC PLC UK. So UK company acquired the shares of the Mauritius company on 1st January 2021 for rupees 10 crore. The Mauritius company acquired the 20% of the shares of the Indian company on 1st January 2022. So basically, UK company is holding in Mauritius and Mauritius is holding an Indian company but only 20% stake. Accounting of period of Mauritius company ends on 31st December. As on 31st December 2022, the book value of the assets was 25 crores. Book value is given. On 31st March 2023, ABC PLC transferred the shares of Mauritius company to another UK company at a price of 50 crores. Book value after the reduction of liabilities. NFMV after the reduction of liability as on the last date of the accounting year is not as on the last date, as on the 31st March 2023 is as under. Mauritius company, ABC Limited, Indian company. Okay. So the transfer as on the date of transfer, it is this price. As on the date of the accounting period end, it is 31st December. So the values are given to you. Now, first of all, here we need to identify the specified date, students. Here we need to identify the specified date, whether it is the accounting period end or whether it is the date of the transfer. So students, what we check first, whether the book value as on the date of the transfer of the assets of the foreign company is greater than 15% of the book value as on the date of the accounting period. So step 1 is what? book value of the assets of foreign company as on the date of transfer is greater than 115% of the book value of assets of the foreign company as on the last date of accounting period. Okay. So if you look at as on the date of transfer, when was the transfer happened? As on 31st March 2023. This is my date of transfer. This is my date of transfer, right? So as on this date, what is the book value of my assets? 30 crore. This, right? Mauritius company's book value is 30 crores. Whether this is greater than 115% of the book value of the assets of the Mauritius company as on the last day of the accounting year. Accounting year ends on 31st December. As on 31st December, what is the value? 25 crores. So 115% of the 25 crores is coming to 29 crores. This is 30 crores. So the answer is yes. So we take the date of transfer as the specified date. Fine. Now the step 2 is whether value of shares of Mauritius company derive value substantially from assets in India. So the first condition, value of Indian assets is greater than 10 crores. Where the first condition is satisfied. Now here the value means the fair market value. But here remember students, the Act says you just don't need to take the fair market value of the assets. It says fair market value without reducing the liabilities. So when I talk about the fair market value over here, this fair market value is without reducing the liabilities. Without reducing the liabilities. But here what it is given, this is after the reduction of the liabilities. The book value as well as the fair market value. For the book value, they do not say anything as such. So book value as it is, I considered. Any which ways, the liability was 0 over there. Is that clear? So here, whether my FMV, what is my FMV over here? FMV will not be 180 crore students. FMV will be without reducing the liability will be 180 plus 20, which will be 200 crores. So 200 crores will be my FMV over here, students. Is this clear? So whether this exceeds 10 crores FMV of the Indian assets? Answer is yes. So first condition satisfied. Second, FMV of Indian assets, whether it is greater than 50% of the total assets of foreign company. Again, you take it as on the date of transfer. So what are the total assets? The total assets of the foreign company are 50 crores. Total assets of the foreign company are what? 50 crores. And the value of the assets of the Indian company is how much, students? 200 crores. No, it is not 200 crores, students. If you remember, here I said 20% shareholding is only there. So you will consider the proportionate holding of the Indian assets. So 20% of 200 crores divided by 50 crores. Here this 50 crores is including the value of the Indian assets. In the earlier example, the bifurcation was given. Here it's the entire value which is given to me. Isn't it? So this 50 crores includes the 40 crores. So this will be 40 crore divided by 50 crores. So it exceeds the 50%. So therefore, even this condition is satisfied. Okay. So therefore, shares of Mauritius company deemed to be situated in India are deemed to be situated in India, and they derive and the transfer of the shares of Mauritius company, the income will be deemed to accrue or arise in India under section 9(1). So the end transfer of the shares, income from the transfer of the shares of Mauritius company, the income will be deemed to accrue or arise in India under section 9(1). Clear? Now, how will you calculate the income? So here also the act says that only the income which is attributable, the income which is attributable to the value of the Indian assets will be deemed to accrue or arise in India. So it says that the income will be attributable, which is attributable to the Indian assets, only that portion of the income will be deemed to accrue or arise in India. Same like it was there under 9(1). Are we getting that, students? So what it says is that the income of the transferor, only that part of the income as is reasonably attributable to the assets located in India shall be taxed in India. Okay. So, income of the transferor as is reasonably attributable to the assets located in India shall be deemed to accrue or arise in India. Now you will say, how will we identify reasonably attributable to the assets located in India? So for that, rule 11 UC gives you the formula. A into B divided by C. And we'll see what is this formula. But first, let's calculate the capital gain. So the capital gain is taxable. This will be as per section 45. As I said, the computation will remain the same for everyone. So my full value of consideration is, what is the value of the consideration? The assets were transferred for 50 crores. The assets were transferred for 50 crores. So my full value of consideration is equal to 50 crores minus the cost of acquisition. Minus the cost of acquisition. So what is the cost of acquisition? So ABC PLC UK acquired the shares of the Mauritius company for 10 crores. Now, first of all, students, whether this will be a short-term or a long-term capital gain? Yes. Students, whether this is short-term or long-term capital gain? So whether indexation will be available to me or not. Yes, students. Yes, faster. What will be the period of holding? 12 months, 24 months, 36 months. What will be my period of holding? This is acquired in 21 and transferred in 23. So what will be the period of holding? Yes, students, you have forgotten the capital gain. Yes, faster. Students, it is LTCG Mancha. So what is the period of holding that you have considered? 12 months, 24 months. Yes, faster students. I need the answers. This is very simple. 12, 24 months. What is it? Nobody is able to give the answer. Students, 24 months is the period of holding, isn't it? 24 months is the period of holding. So therefore, because it is unlisted shares, it is not listed on the recognized stock exchange. Even let's say, for example, this would have been listed on Mauritius Stock Exchange, still it would be unlisted in India because it should be listed on the recognized stock exchange in India. So this is unlisted. So period of holding is 24 months, isn't it? So it is held for more than 24 months. So this is the long-term capital gain of 40 crores. Now this entire capital gain will not be taxable in India. So capital gain accruing, or you can write deemed to accrue or arise in India is equal to 40 crores into, so A is the capital gain, into B is the FMV of Indian assets as on the specified date, divided by the FMV of the total assets of foreign company as on the specified date. So this will be 40 crore divided by 50 crores. So this will be 32 crore. So the capital gain taxable in India deemed to accrue or arise in India will be 32 crores. Here, indexation will not be applicable, students, even though this is long-term capital gain, because the LTCG is taxable under Section 112 at the rate of 10% without giving benefit of first and second proviso to Section 48. Are we clear? So, Section 112 says that the tax on the unlisted securities will be at the rate of 10% without considering the first and the second proviso to Section 48. Are we clear? So, there here the tax will be 10%. So that is why we are not considering the indexation over here. All the students, is this indirect transfer clear to you? Yes or no, students? Faster. I need the answers. Students, please fast. We need to cover up many more things. Yes. Shall we move on to the next topic then? Any questions to anyone? Okay, so now I'm going to talk about only capital gains. So we are going to cover the other capital gain provisions which are applicable to the non-residents. So that is what we are going to cover now. Okay, so capital gain taxation for the non-resident. What are the different provisions for them which are applicable? Yes, Mansha, you will need to revise again. Namrata, in the last uh, point that I made is that the income from the capital gain which is accruing or arising to a non-resident, not entire income will be taxable. The income only as is attributable to the assets located in India shall be taxable. So what are the assets located in India will be determined by the formula which is capital gain into the FMV of the Indian assets as on the specified date divided by the FMV of the total assets of foreign company as on the specified date. So only proportionate capital gain shall be taxable in India, not the entire 40 crores. And here the tax rate of 10% will be applied, which is on the unlisted security, which provides for no indexation, no first proviso to 48. So therefore, we have not considered the indexation over here. Are we clear? Yes. So first you determine the specified date, then you determine whether the value of the Indian assets derive the value substantially, value of the foreign company's assets derive the value substantially from the Indian asset. Once you determine that indirect transfer is applicable, then calculate the capital gain and then calculate the proportionate capital gain. And this is what will be taxable in India. Fine, students, yes or no? Shall we proceed further? Okay. So next, write down capital gain taxation for non-resident. So the first provision which is applicable is first proviso to section 48. Read with rule 115A. So this is the foreign exchange fluctuation benefit which is available to a non-resident. So what is this? Let us consider and we will do one example also. Okay. So basically, there are two provisions which are applicable only to a non-resident, which is what we are going to consider over here. Number one is the first proviso to section 48. So the first proviso to section 48 says is that in case a non-resident purchases the capital asset using the foreign exchange, then the exchange rate fluctuation benefit will be allowed while computing the capital gains on the transfer of those shares. So this is the benefit of exchange rate fluctuation. Benefit of the exchange rate fluctuation. Are we getting this? Benefit of the exchange rate fluctuation. So this is a mandatory provision. It is not that it's an optional, it's a mandatory provision. Okay. Now this is applicable in which circumstances? So this is applicable to a non-resident This is applicable to a non-resident. Okay. This is applicable to a non-resident on the transfer of the shares or debentures of the Indian company. So, capital asset eligible is shares or debentures of Indian company. Meaning, first proviso to section 48 will not be applicable in the case of indirect transfer. Because this was not the share of the Indian company. What was transferred was the share of the foreign company. So first proviso to 48 any which ways is not applicable in the indirect transfer because it is applicable only on shares or the debentures of the Indian company. That's it. So if the total income of the assessee includes the transfer of capital gain arising from the transfer of the share of the Indian company or debentures of the foreign company. In that particular case, the first proviso is applicable. However, if you look at the long-term capital gain on sale of the listed shares, long-term capital gain on the sale of the listed shares on which the STT is chargeable at the time of purchase and at the time of sale. There, section 112A is saying that the first proviso will not be applicable. So not applicable where section 112A applies. That is listed share where STT is paid at the time of purchase plus sale. So maybe a listed share where STT is not paid and which will not be covered in the exceptions of 112A also. Remember there were exceptions of 112A like bonus shares, shares received on amalgamation on which genuinely STT could not have been paid. So at that point in time, you can apply the first proviso to 48. Similarly, section 112 also says on the unlisted securities, 10% is payable without the benefit of the first and the second proviso. So even in the case of unlisted securities, the first proviso is not applicable. So meaning you can apply the first proviso to 48 only in case of listed shares, only in the case of listed shares where the STT would not have been paid. Because otherwise 112, 1128 does not allow you to claim the benefit of first proviso to 48. Are we getting that? So basically you can write down applicable only on listed shares where STT is not paid and not covered by the exceptions of section 112A. Clear? Yes or no? Okay, then how the exchange rate fluctuation benefit will be calculated? So for that, rule 115A gives you the benefit. It says that average of TTBR and TTSR, you have to take into consideration to convert the cost of acquisition as on the date of acquisition of the capital asset. So, the cost of acquisition, you will first convert it using the TTBR plus TTSR, the average of this. The average of this as on the date of the acquisition. As on the date of the acquisition, you will consider the average of the TTBR plus TTSR. So first you will calculate the capital gain in the foreign exchange. First you will calculate the capital gain in the foreign exchange. Are we clear? So step 1 is convert the cost of acquisition, full value of consideration, expenses on transfer to the foreign currency, and calculate the capital gain in foreign exchange. So your step 1 is compute the capital gain in foreign exchange by converting FVC, cost of acquisition, or the expenses in transfer to the foreign exchange. So this is as on the date of acquisition. Then the full value of consideration, you will again take the average of TTBR and the TTSR as on the date of transfer. And similarly, it is for the expenses on the transfer as well, for both of them. And then step 2 is reconvert the capital gain. Reconvert the capital gain computed in foreign exchange recompute the capital gain which is computed in foreign exchange by multiplying it with the TTBR as on the date of the transfer. TTBR is telegraphic transfer buying rate and TTSR is telegraphic transfer selling rate, which is the rate of exchange adopted by the SBI. Okay, so if I have to give you an example for this, to understand how this particular 115A rule works. So let's take an example. Okay, let me give you the example. It's not getting pasted once again. One second. Should say some issue in this app only. Okay. So NR purchases shares of ABC Limited on 1/1/2013 by remitting the USD. Cost of acquisition is 5 lakh 85. Date of sale is 1/1/2023. Sale price is 9 lakh. Expense on transfer is 6,600. Now, ABC Limited is a listed company, but shares are purchased through an off-market transaction. This transaction does not fall under the exception notified by CBDT. And the exchange rates are given of the TTBR and TTSR. So what we'll do is, student, step 1 is calculating the cost of acquisition. So what you will do, step 1 is calculating the capital gain. So first I'll take the sale price, which is, let's say, my 9 lakh rupees. So first FVC, this is in INR and this is in USD. Okay, so this is 9 lakh. Now I'll convert this into using the TTBR. So 9 lakh, 1 USD is the rate is given TTBR and TTSR, right? So what I will do is exchange rate I will take, which is as on the date of transfer. The transfer has happened on happened on 1/1/2023. So on 1/1/2023, 39 plus 41 divided by 2. So this comes to 40. So in USD, this will be 22,500. So 9 lakh divided by 40, this is 22,500. Less expense on transfer, 6,600. So again, I will take here 40. So 6,600 divided by 40. This comes to 165. So net sale consideration is 22,335. Right? Then cost of acquisition, cost is on 5,85,000. Indexation, as I said, will not be allowed in this situation. So as on the date of acquisition, acquisition was made on 1/1/2013. So I'll take the exchange rate on that date. So 38 plus 40 divided by 2. Which comes to 39. So 5,85,000 divided by 39. This comes to 15,000. So this will be long-term capital gain because it is more than 12 months as it's a listed share, right? So this comes to 7,335 into, now I'll reconvert. The step 2 is to reconvert as on the date of transfer. So TTBR as on the date of transfer is 39. So my capital gain will be 2,86,065. Is this clear, students? So this is how the capital gain needs to be calculated. Yes or no, students? Yes? Fine? Yes or no? So this is applicable both in the case of the long-term capital gain as well as the short-term capital gain, students. Yes, any questions, any doubt? Yes? Now let's say, for example, students, Mansha study material is enough. If you read the Bare Act, you will get confused. Okay, students. Now, let's say, for example, I make one more addition over here. Let's say I make one more addition over here. Let's say in this scenario that this amount which was sold, the amount which was sold, out of the sale proceeds, another shares were purchased. Let's say my sale proceeds were how much? 9 lakh. Out of this 9 lakh rupees that I have received, another share was purchased. Another share was purchased. So let's say, for example, I'm putting it over here. So let's say on 24th April, 6,15,000 was invested in the shares of ICICI Bank out of the sale proceeds of 9 lakh, which were sold on 31st 12 2023. So again here, on every reinvestment out of the foreign exchange, original foreign exchange, on every reinvestment, the first proviso to 48 will be available. So first proviso to section 48 is available on the reinvestment as well. So it is not only that when I have initially utilized the foreign exchange, if I am reinvesting the amount, on that as well, the first proviso will be available. So here also my FVC is 10.5 lakh, right? So what I will do is, on this date, I will convert it into the foreign exchange first. So 31st 12 2023, 41 plus 43 divided by 2, which comes to 42. So 10.5 lakh divided by 42. So this comes to 25,000 less the cost of acquisition. This is the short-term capital gain because it is less than 12 months, right? So the cost of acquisition is 6,15,000. So as on the, now which date I will consider for the cost of acquisition? So for the cost of acquisition, as on the date of the acquisition. So I have acquired on 24/4, so I will consider the same date, which is 40 plus 42. So it is 40 plus 42. So this is coming to 41. So therefore, 6,15,000 divided by 41. This comes to 15,000. So this is my short-term capital gain. This is 10,000. Now again, I will reconvert it using the TTBR rate as on the date of transfer. So it is 40. So 4 lakh. So this is my short-term capital gain. Okay. This is my short-term capital gain. So even on short-term capital gain, the shares will get the foreign exchange fluctuation benefit. Any questions, students, so far? Yes. Any questions? Any doubt? Yes or no, students? Yes. Okay. Yes or no? Any questions? Any doubt? Is this clear? First proviso to section 48. Yes or no, students? Fine. Okay, students. Faster. Any questions? Any doubt? Yes or no? Okay. So we'll stop here for today. The TTBR should be 41. Mohammed? Yes, the TTBR is 40. How 41 you are saying? It should be 40. TTBR as on the date of transfer, Mohammed. It is 40, right? This one. How 41? It should not be 41. Yes, Namrata, you will have to revise. In the next class, what we are going to do is we are going to have the capital gain tax for the non-resident Indians, which is separate under a separate chapter itself that is given. So that we have to do. Then the capital gain taxation in the case of the FPIs, that is something we will have to do. And the capital gain in the case of sale of GDRs, that is something we will have to do. So we are left yet with 3 capital gains as yet. Are we clear? So that is something which we still have to do. Okay. So ADR, GDR, FPI and the NRIs. So these are the 3 provisions that we still need to do. Fine, students. So let's stop here for today. Please revise and come in the next class. We still have like many provisions to be done even in the next class. So in the next class, we are going to do the capital gain and then we are going to go to the other parts of the non-resident taxation, which is the royalties, FTS, all of those provisions we are going to discuss. Okay. So thank you so much. See you in the next class.